All right. Hello and welcome to The Upside with Eli. We're joined today with Brandon Murphy, CPA. In traditional fashion, we've gotten a whole bunch of questions from you guys who have been listening to the podcast, other episodes, and commenting on social media. We got a whole bunch of questions to kind of go through today. And it's it's not tax season yet, but we're coming up hard on tax season. We're on RRSP season right now. So we're going to go through a whole bunch of timely questions. And if you do have additional questions that you would like us to answer, please put them in the comments, and we'll have them on our next episode. So anyway, Brandon, welcome.
Thanks for having me back.
Yeah, of course. We're in a new year. Tax season 2025, technically, for 2025, tax season 2026, I guess how you want to call it. What do you got on the horizon?
Yeah, tax season came around, snuck up on us again, and it always comes up quick. But like you mentioned, I think the big thing coming up here first is the RRSP contribution deadline. So we're looking at March 1st this year, not February 28th. Falls on a Saturday. So everyone's got up until March 1st to make those RRSP contributions. And as we know, you make the contribution up to March 1st, you can carry that back and claim it in 2025, or you have the option to also claim it in 2026 and deduct that against your income.
Yeah. And so why would somebody not claim it for 2025?
Really, that's kind of a forward-looking number that we're looking at. So we want to assess what someone's income is going to be in 2025 versus what it's going to be in 2026. If you anticipate any sort of spike in income, whether you own a business and you're going to be drawing more from that business in 2026, or if you're an employee and you're expecting a promotion or an increase in your income or a large bonus in the upcoming year, that's when we want to be more strategic, take that deduction in 2026 because you're going to be in a higher marginal tax bracket. Of course, if you take the deduction in 2025 and you have the room to take that deduction in 25, it generally makes sense because you're getting that refund a lot sooner, and then you can use those funds to whatever it is, pay down debt, invest it back into your RRSP or your TFSA, and leverage those funds sooner rather than CRA hanging on to it for another year.
Yeah, they don't give you a lot of interest on your money, do they?
Zero if they owe you money back and it hasn't, and there's no mistake on their end.
Yeah, but you make a mistake, you'll definitely pay for it. Yeah, they're not very kind that way. So in terms of tax filings, we talked about RSP, kind of deadline for 60 days. What are the deadlines for 2026 here for tax filing for last year?
Yeah, those deadlines are coming up quick. So the first big one we look at is April 30th. So anyone that's simply an employee, they don't have any business income, they have to file and pay their taxes by April 30th. If you're self-employed, you have until June 15th to file your tax return because there's additional nuances that come with filing a business tax return, but you still have to pay the taxes by April 30th. You just get that additional time to file by June 15th. Usually, I don't like to have T1 season push into June. So if we have all the information, all the numbers, let's get it filed. Let's get the taxes paid by April 30th.
Yeah, and that seems to catch a lot of people off guard because, and maybe it's just not well advertised or well explained to a lot of people. I'm not sure where the misses come from, but as a self-employed individual, you don't have to file until June 15th. But if you didn't pay the taxes that are owed once you do file in June, if you hadn't paid them by April 30th, what are the penalties actually that are in place that you're going to get hit with?
Yeah, so if you kind of were in the mindset that you don't have to file and you don't have to pay until June 15th, I'd have to refresh on what the current interest rate is, but I think the penalty on late filing would be 5%, but what you would be targeted with is an accrued interest of about a month and a half from April 30th to June 15th, where you're going to have to pay interest on the balance that you owed on April 30th.
And that might be in addition to if you have installment payments as well.
Yeah, that's right. If you didn't make your installments for the prior year, you could be subject to installment penalties and installment interest. But someone might also have installments that they're now owing for the 2026 tax year that they haven't prepared for. So you missed that first deadline as well. Could be additional interest and penalties.
Yeah, makes sense. I think the most important takeaway is that if you are self-employed, even though your filing deadline is June 15th, that is not the tax paying deadline, which I think catches so many people off guard. They go, why is that the case? And it's just, well, it is what it is. So you got to deal with it.
Yeah, exactly. And I think the biggest thing is if you have the information, December 31st is past us, you probably have all your kind of receipts, you know what your income is for 2025. Let's get a head start on it. Let's get the draft together so that we know what that number is kind of come March, April.
Yeah, makes sense. Which kind of takes us to our next question around, getting all that information, kind of gathering it. When should people expect to receive their tax slips?
Yeah, that's a good question. Tax slips kind of come at two different deadlines. So the first one for employers is by February 28th. Sorry, normally February 28th. This year they have until Monday, March 2nd. That's when you can expect T4 slips, T5 slips to come out from the banks. But then the challenge is the T3 slips. All of the trust companies have until March 31st to file their trust returns and issue those T3 slips. So sometimes we don't see those T3 slips coming through the mail or into the client's hands until those first couple weeks of April.
Yeah, and I think people are often, again, confused because they think, well, they're supposed to have this stuff sent out by a certain timeline, or I'm supposed to receive it, and it tends to be a little bit later than obviously people would ideally like. But absolutely, is there any slips that come after the tax filing deadline?
Slips after the tax filing deadline? Not off the top of my head, no. You should have everything in your hands ready to go by April 30th.
100%. So just being aware that, yeah, like as you said, some of it might not be sent out till March 31st. However, you absolutely should have that in your hands before the tax deadline. And a lot of companies now are going to more of an online, type structure where you're not receiving stuff in the mail. There's certain things that you're supposed to be, but a lot of that stuff is available online and you can access that faster.
Yeah, exactly. I mean, last year was a bit of a nightmare. So generally, CRA should get all those tax slips. What your accountant's going to do is they're going to go in and they're going to connect your tax return to CRA, meaning that all that information auto-populates into the return as far as slips go anyway. Last year, lots of challenges. A lot of the slips weren't uploaded into May or June even.
Yeah.
So we were having to actually go through line by line of the individual T3 slips and reconcile those numbers. And then we would get the actual in May or June or whenever CRA would upload the information, and sometimes had to amend the return.
Yeah, I remember. I mean, last year was brutal because CRA came out and they said that, well, actually, that service was just... They were just doing it to be helpful, but that wasn't a requirement of their service. And we'd been used to using that for years and years and years. So I remember, as a firm, we had to manually go through. And for a lot of clients, they have, 5, 10, maybe even more, slips, especially on non-registered accounts we're getting from different, fund codes and different things. And it was like literally months worth of work just to do that because it was no longer automated like it used to be.
Administrative battle for everyone on both sides.
Yeah, except CRA's side. CRA just got to not have to do it, and accountants and advisors had to deal with the fallout.
Yeah, and they say, no, still owe your taxes, otherwise there's interest and penalties.
Yeah, exactly. All right, so getting back to RSP deadline, I guess why is it so important to kind of look at your situation in the first 60 days of the year? What are the main advantages of RSPs?
Yeah, that's a good question. So basically, to take it back to kind of square one, when you contribute to your RSP, you get a deduction that is against your top line net income. So the benefit of that is you're reducing your taxable income. So if we use simple math, for someone that's in the highest tax bracket, if they make a $10,000 contribution, whether it's in these first 60 days or in 2025, they make a $10,000 contribution. You're in the highest tax bracket in Alberta is 48%. you're essentially getting $4,800 back on your 2025 tax return. So that's the biggest benefit. And that's also why we want to do that forward-looking planning to make sure that your income in 2025, if it's going to be relatively consistent with what you're seeing in 2026, well, it probably makes sense to make the deduction in 25 if you have the room to make the deduction.
Yep.
Because you'll get that refund sooner. Even if you're not in a refund position, you're going to owe a lot less tax by making that RSP contribution. But yeah, it's basically you get the deduction off your top line income, which means it's impacting you at whatever your marginal tax bracket is.
And why, it always, we always get comments on social media about, well, I thought if I dumped 10 grand into RSPs, I've saved $10,000 in taxes. Where do you think that, I guess, miscommunication or misunderstanding kind of comes from it, and how does it actually work?
Yeah, I think it's probably marketed that way. If you make this contribution, some people might say, well, it's a write-off. I'm going to get that money back. Not exactly a write-off. Basically, if you go into the nuance of the Income Tax Act, what's happening there is you make the contribution today, so you get your deduction at your marginal tax rate. So say 48%, you're getting the $4,800 back today. Once you reach retirement and you pull that money back out of your RRSP, that's going to be all taxable income. So really what we're looking at with RSPs, and could go into a conversation of RSP versus TFSA, is if we're making the contributions, we're making the deductions today, we're going to assume that your tax bracket today is higher than what it's going to be in retirement. And that's where you get the ultimate benefit out of making RSP contributions. If your tax bracket is a lot lower today, or you have a income year that's kind of just lower than expected, then TFSA might make more sense for the contribution, or make the RSP contribution and carry it forward to a future year.
Yeah, no, makes perfect sense to me. And I think the main takeaway for people is that it's a deduction, not a tax credit, right? So it's reducing your taxable income. It's not reducing your tax bill on a one-to-one basis. And I think a lot of people, just initially, if they're not really well informed or super nuanced around, kind of tax, understanding the difference between credits and deductions is it's a pretty material difference.
Oh, absolutely. Yeah. When you look at kind of a federal level, you're getting that tax deduction if you're in the highest tax bracket at 33%, but your credits are always limited to 15% right now. I guess for 2025 it's 14.5% on the federal level. So a lot more benefit to have deductions versus credits.
Yeah, makes sense. Another question that we often get, people always want to ask us, what are some deductions and credits that people tend to overlook or miss or not take advantage of? And I guess the other kind of counterpart to that question are, what are the things that people need to be telling their accountants about if they're not filing their taxes themselves? So why don't we start with one? It's kind of a two-part question here, but yeah, what are some of the credits and deductions that people commonly overlook?
Yeah, that's a good question. So there's various credits and deductions that are kind of automatically applied in your tax return that are generally not missed or shouldn't be missed unless you're manually filling out your tax return on paper. I hope no one's doing that these days anymore.
I think CRA still reports the number of people that are sending in like manual paper return. It's a pretty small number now, but there's a lot of people obviously who file taxes in Canada. I think it's only about 9 out of 10, but it's still a large number. So even though the percentage of people filling out paper returns is low, it's actually still quite a few people.
Yeah. It's and I guess they like the exercise of pen on paper and get the calculator out and actually watch the numbers flow through. Best way to understand a tax return. One of the first times I did it was write it all down on paper, and that's when you really comprehend marginal tax brackets, deductions, credits, everything. But anyway, I've kind of taken us off course with that one.
But yeah, in terms of those deductions and credits that are commonly missed, what should people know about?
Yeah, and it's kind of, you got to think about the events that have happened throughout the year, and some of those events can generate deductions or tax credits. So RSP contribution, I'll start with deductions. RSP contributions, give those contribution slips to your accountant. Another commonly missed one that's quite beneficial is the childcare deduction. And this can be claimed by the lower income spouse. It kind of varies based on the age of your children and how many children you have, but it can be a significant deduction. And basically, for that one, you just want to keep track of kind of if you're paying for childcare, babysitting throughout the year, have the receipts for all of that, and then you can claim that deduction. In terms of deductions, I got a couple for business owners as well. So, and these are generally the non-cash ones. So they're things that you don't see coming out of your bank account or off your credit card statement. So the biggest one I'd say is home office expenses. If you have a home office allocated and it's kind of the primary place that you do business, and it doesn't have to mean you're meeting with clients there. It could just mean that that's where you're doing all your administrative work for your business. You don't really have a regular office that you're going to Monday to Friday. You can deduct a prorated amount for your home office use, and you're supposed to prorate it again for the portion of the day that you're using it as a home office. If it's used for other things, you got kids in there doing your homework, maybe the other spouse is in there working on their business, you can only prorate it for their portion. It's a non-cash thing that a lot of people miss, and sometimes your accountant may not even ask about it. So something to keep top of mind come tax season. And if you bring it up with your accountant, they should know how to do the calculation and what questions to ask. And I'd say another one is vehicle expenses. If you're, again, we're talking about sole proprietor here, but you can deduct your vehicle expenses for the year. If you're using kind of a personal vehicle for business, you can deduct your mileage on that. Usually the simplest way to do that is keep a mileage log throughout the year of anywhere that you're traveling to meet clients or run your business. Keep that mileage log of everywhere you've been, why you were there, who you were meeting with, and then you can claim a deduction on your self-employment side for your business.
Yeah, right on. And I think it's funny you bring up those two, especially in terms of like home office and vehicle mileage and that. I think there's a lot of misconceptions around what you could actually deduct related to home office expenses and some of the other things that attributed to it, and for mileage and that as well. And I think a lot of people get caught up with they think they can write off way more than they actually can. So it's probably a good idea too to review what you can and cannot actually deduct it and write off, because we always tell people you can put whatever you want in your tax return, but if you get audited, you kind of need to know the rules based around that, because we'll see some pretty interesting things online about what people advertise that you can actually deduct versus what you can't.
Yeah, no, it's good to keep a record of everything. Like what I always tell people is we're not going for perfection. You may not have a receipt for every $5 expense that you're claiming in the year. And generally when you're audited, they're going to look at specific line items. They're probably not going to look at every expense that's on your books. So it's just being prepared that if you're going through that, try to be 90% of the way there with your backup.
Yeah, makes sense. Cool. Now, in terms of things people need to be telling their accountants about, so if you are using an accountant, what are some of the things that as an accountant you need people to tell you about when you're filing their taxes?
Yeah, for sure. And there's things you can tell your accountant that might cost you more tax. There's things you can tell your accountant that are going to save you tax at the end of the day. And I'll focus on a couple beneficial ones to start. This goes back to tax deductions and credits, but it's moving expenses.
Okay.
So if you had to either relocate for work or school on a full-time basis, more than 40 kilometers in the year, keep track of all those expenses. You can claim a moving expense deduction. So beneficial, save you taxes at the end of the day. And I think, again, it's kind of one of those non-cash things that a lot of people miss, or they don't even think to tell their accountant. The second one is either purchasing or selling principal residence or a rental property. Of course, you should tell your accountant all those things.
Yeah.
But on the principal residence side, if you purchased a principal or new house in the year, you can get a new home buyer's tax credit, $5,000 tax credit. You'll get that at a 15% credit rate, so about $750 back on your return. But hey, $750.
Yeah, absolutely. And I think people, they often tell their accountants about the things that are like taxable events that they know that they should be telling them about, or you're going to get a slip, for a lot of that stuff anyways. But I think principal residences are one of those things that are just commonly like not told an accountant, whether you're buying your first house or buying and selling or moving and that kind of thing. I think that, a lot of people surprisingly just don't think that they need to bring it up, so they don't.
Yeah, especially on the purchase side. That's the most common one is I'll start doing a tax return and I'll see an address change somewhere. It's like on a T4 slip or something, and give them a call and it's like, hey, why do you have a different address on your T4? And it's like, oh, we sold our last house and we moved into a new one this year. And even on the sale side, I think people are cognizant of not telling their accountant about that. They think they're going to owe tax even on a principal residence. But if you sold your principal residence in the year, you're most likely eligible for the principal residence exemption.
Yep.
But in order to get that, you still have to report it on your tax return.
Yeah.
It's basically ticking a box, making sure it's on there and filed. But it's really easy for CRA to pick up on those things because they'll see an address change at some point. So that's why it's important to report it.
Yeah, exactly. Cool. We had another question around RRSP carry forward. So for people that make that contribution now, and there's really no need if they plan on making a contribution at some point, but they've been told, why don't I just make that now and then just carry that deduction forward and use it 5 years from now when I'm back working or things like that. So I know we're kind of jumping around here, but I wanted to address that question because it's come up a few times. So how does that carry forward work?
Yeah, so you can make a contribution to your RRSP today. And I mean, if you did it today, you have the option of claiming it in 2025, you can claim it in 2026, or you can carry that forward. The reason we would want to carry that forward is if your income is low this year or last year, but your income's going to increase in the future. And usually when I run out these calculations, we got to factor in what kind of return you would get on that deduction that you get today, on the refund you would get today.
If you are working and there is one.
Yeah.
Exactly. Versus you might see people that are, off on maternity leave or they're collecting disability and they're going, well, I've got the extra cash, we've got a new year, I've got the RSP room. I could dump that in knowing that I'm going to be going back to work a year from now, 2 years from now, 3 years from now, and I'm going to be in a lot higher income. So I might as well get the tax sheltering started now, even and then just kind of carry that forward to some of those subsequent years.
Exactly. Yeah. And it makes the most sense where you are going to see that huge spike in tax brackets between this year and the future year when you go back working and then claim the deduction in that year.
Yep. Exactly. Cool. The last one we wanted to chat about, which has come up a few times, is OAS clawback, and understanding kind of on a tax return. It's a little bit nuanced because of the gross up mechanism of eligible versus ineligible dividends. How does that work in terms of which lines are they on, and why do people get so confused about OAS clawback? Because we'll deal with it all the time where, I'm explaining to a client, well, your OAS is clawed back based on the grossed up number because it's based on that line, not on your total net income after you've received the tax credit. So why don't you just walk through that?
Yeah, for sure. And I can kind of take a step back on what OAS clawback is and if it happens to you, what's going on in the back end. So basically, you'll collect your OAS throughout the year. We get to tax filing season, and that's when you're going to report all the income you had, say, in 2025. And OAS clawback is based on gross income, like you said. So this is everything from employment income, rental income, investment income. If you run a business, that self-employment income is going to be in there as well. Generally, we're seeing lower income levels for retirees because they often aren't working while collecting OAS. But basically, yeah, so that OAS clawback threshold starts at $93,000 of gross income right now, and it'll get clawed back at a rate of 15%. So when I'm looking at someone's tax return, to me, that's an extra 15% tax that maybe there's ways we can avoid that if we can. Fully clawed back at, is it 153,000 for the upcoming year, I think?
Yeah, well, it also depends on whether you took it at 60, 65, 70. But yeah, I think that's at the 65 number. That's what that works out to. Yeah.
Yeah, so then you're fully clawed back in that year. So there's things you can kind of do sort of very short term to manage that. You brought up eligible versus ineligible dividends. Business owners generally are going to be drawing more ineligible dividends if you have investment accounts. A lot of that's coming out of public companies, mutual funds, where you're seeing eligible dividends. So that's where, as an advisor, we want to watch what kind of investments the individual has, because if you have eligible dividends, those get grossed up at 38% in that gross income number that's then used for OAS clawback.
Yeah.
So if we can
finish your thought there.
Yeah, so if we can manage that and generate different types of investment tax, whether it's capital gains or interest income, we might be able to lower that gross income number and reduce OAS clawback.
Yeah, and I think where a lot of people get caught is they'll pay themselves enough income out of a business to get right up to that threshold, and then they don't realize that that number gets grossed up.
Mm-hmm.
And so what happens is now you've increased your OAS clawback by up to 38%, right? So you got to kind of understand that. And the unfortunate reality is by the time you see the tax return, a lot of the time it's too late. And so that's why you need to probably, either, generally we recommend sit down with an advisor and actually build out kind of that whole retirement drawdown structure so you're not getting nailed with that, because that's when that catches people off guard. Obviously, if it is an ineligible dividend, it's grossed up by a different number as well. So we'd look at, your general rate income pool and kind of what taxes have been paid on that and what kind of taxes you're going to pay on that dividend. But that's a super common question. So I appreciate whoever's been asking that one a lot. That makes sense.
Yeah. And I guess from your perspective, when you're working with a client that is a business owner, they're now in those retirement years and they're kind of in that wind down drawdown strategy for their business. What are things you watch for in terms of managing OAS clawback over a 5-10 year period?
Yeah, I mean, the main one is, can we manage it, or is your income just going to be so high all the time that there's, you're going to lose OAS always, which is, a good chunk of the clients that we work with. But there's still a lot of people that we can at least get it for, X number of years. And a lot of the times it's deferring OAS. One, you're going to get that deferral bonus there. But then we can start getting just more money out of the corporation earlier when we're not worried about, losing that OAS, or getting more money out of RRSPs earlier before you have to start stressing about that OAS clawback. Now, some people say, I don't really care. It's only, $700 a month. That's pretty immaterial to my overall retirement. And some people go, man, that's $700 a month. That's a massive chunk of, my retirement income. So it's going to vary kind of from person to person. I think everybody's goal should be to, pay the least amount of tax possible and maximize, your spending abilities throughout your retirement, or that you want to, kind of pass on to the next generation. I think most people would agree that that's their goal, is pay less tax and grow their money more efficiently. But it's looking at how much do you have inside the corp versus how much do you have in, kind of some of these taxable accounts like RSPs. How are your overall investments structured? And then how can we work everything to maximize stuff based on your individual goals?
Yeah, that makes sense. I mean, if you're in that range and you can avoid that 15% tax, we're going to work around that.
Absolutely. Right on. Cool. Well, that's all the time we got for today. But if you were watching, hopefully if that was one of those is one of your questions answered, hopefully that was the answer you were looking for. Those are all the correct answers. So if that wasn't the answer you wanted, well, sorry, that's just the way things work.
That's tax.
That's tax. If you have any other questions, please put them in the comment and we will add that to the list for, I think our next recording is either next week or the week after. Brandon, as always, appreciate you coming on and sharing everything with us. If you are interested in working with Brandon, either as an advisor or from a tax standpoint, feel free to reach out and we can absolutely get you connected.
Right on. Thanks, Eli.
Okay, take care.